On the Tape is presented by CME Group, where risk meets opportunity. iConnections, reimagining how the investment industry connects, and SoFi. Get your money right all in one app.
Welcome to the Monday edition of On the Tape podcast. I am Dan Nathan, joined as always by Guy Adami and Liz Young. That would be EY from SoFi. Welcome, people.
Heyo.
What up?
We have a huge show. Guy and I had a great conversation late last week with Jeff Toporek. He is the principal and co-founder at FD Stonewater. We talked about the constipated commercial real estate lending market. That was a term that he used, Guy. It was in his notes, and we had to go right there because it was actually kind of interesting. I think it was, a good use of the term, not the way that you might use it after we are doing a segment on, I don't know, Chipotle or something like that. That's a term that we often use. But we also talked about the logistics market, deglobalization, reshoring, and just really some of the investments that they're making, some of the trends that they are seeing. It was a great conversation. So stick around for that. We have a big week. I know that we're kind of moving our way into year end. We have the Fed, the all-important last Fed meeting after the all-important last jobs report. We're going to talk about that. We're going to talk about the move in yields. We're going to talk about just kind of equities melting up. It's I know, Guy, this is going to get you all worked up here, but it seems like more and more of the financial press are using that term, the everything rally. And there's also some other terms that are being thrown out to describe what the Friday jobs report was like, but we're not going to say that just yet here. We got some earnings still, big software names, and a huge, massive retailer here. Let's do it, guys. This is kind of one of our last Monday pods of the year. Thoughts, because we had the S&P, Liz, that closed at a new 52-week high. We have, if I'm looking at the options market, maybe you guys will find this kind of interesting. Okay. Let's just do this for a second. The weekly S&P, that's including this Fed meeting that starts tomorrow, ends on Wednesday. The weekly move implied in the S&P 500 is about a little less than 1.5%. If I were to look at the at-the-money straddle on December 29th, okay, that gives me only a 2% implied move in either direction between now and the end of the year, the closing tick of the year. But look at this, the TLT, okay, that is the iShares 20-year Treasury ETF, okay, the implied movement between now and year end, 3.3%, Guy. Talk to me about how we can be in a situation where the TLT implied movement is greater than that of the S&P 500, which just closed at a new 2023 high.
Yeah, we've seen bond volatility outpacing equity volatility. Probably, better part of the last 2 years, I would imagine, since the Fed obviously made those comments in the fall of 2021 and then obviously subsequently moved in 2022. So that doesn't necessarily surprise me. What I've thought but have been wrong about is, I thought at a certain point, bond volatility almost by definition would make its way into currency volatility, which we've seen, and then subsequently equity volatility, which quite frankly, with the 13 VIX, we haven't seen. Now, people will say these zero data expiry options may be contributing to that. I really don't know. I can't speak intelligently about that. But what I will say is, regardless of whether or not that's impacting it, a 13 VIX, again, given the backdrop of all the things that we talk about, and then subsequently all the bond volatility just doesn't make sense. So you have to ask yourself, what is the problem? Why are people seemingly happy to be short of volatility here and continue to basically, sell vol in an environment, quite frankly, where I think they're playing with fire?
Yeah, Liz, Guy makes a great point. In periods past where we've seen volatility in commodities, in FX, and obviously in the rates market, ultimately it works its way into the stock market. And I wonder if this is a bit technical. You mentioned this before we got on, the VIX on Friday, and what a lot of folks were like, thought it was the best case scenario, right? For the Fed, for the economy, for the consumer, for the markets, as far as that November jobs report, we had a VIX that was up, more than 5% or so. Now, in and around 13 or whatever, and very near multi-year lows. Do you buy into the fact that ultimately, if we are going to see all this volatility in other risk assets that are saying all, whole host of different things, that ultimately has to manifest itself in the stock market?
It's interesting right now. It seems like everything's just operating independently from one another. You've got the bond market sending signals that things are bad. You've got the stock market sending signals that we're in the greatest expansion of all time. And the VIX is just sort of sitting there, on drugs in a catatonic state. The weird thing about Friday was that market up, VIX up. That's not usually what happens. Market down, VIX up is usually what happens. So I don't know that that sends a very clear signal in either direction. But to Guy's point, there are just a lot of inconsistencies in the market. And there's a lot of signals, there's a lot of indicators trying to fight for that winning spot of I'm right, you're wrong. And we just don't know the answer to that yet. But the reality is, after that jobs print on Friday, and that was after we got a preview from Jolts, we got a preview from ADP that said the opposite would happen. And then the official data came in stronger than anybody really expected, including the unemployment rate. After that, I mean, it's difficult to sit here and try to make a case and say things are terrible because it looks like right now things are still pretty good. And we've talked about this for the last few weeks. I do think the market can keep running through the end of the year. Yes, a lot hinges on the CPI report tomorrow. Yes, a lot hinges on if the Fed changes its tune on Wednesday. But if nothing big comes out of either of those, we probably stay supported through the end of the year. I think we said this last week. Christmas transcends everything. People are still spending. They want to be spending at any cost. And I think that we're probably still okay through December 31.
Yeah, so Guy, as inflation expectations have come down, and again, not just readings, okay, but like year out expectations, we've seen this surge in consumer confidence. And again, you've made this point again, again, and again. I've heard you say it for 10 years, is that really when you look at consumer confidence, it's kind of like an overlay of the S&P 500. And I know that you don't mean that they're that, well, they are very correlated, you know what I mean? But I guess the question is the tail wagging the dog? And you make the point all the time, it could stop on a dime.
What I've said again, and I believe this now, people have their own interpretation, but your point about the consumer confidence in the stock market, I'm not suggesting that everybody owns stocks. That's not my point. We know the statistics say otherwise. But what I will say is, I think a lot of people sort of have an understanding of how the stock market is doing vis-a-vis a number of different things. So whether they own stocks or not, if the stock market effectively goes up every day, which is what we've been seeing in large part, we are now through the levels that we saw over the summer in terms of the S&P 500 with winter earshot of an all-time high. So as long as the market does well, people make the following calculation. Well, the stock market's doing well. That must mean the economy's doing well. And I know what my neighbor makes, and he or she can afford that trip or car or Starbucks or whatever. I should be able to do it as well. So there's this sort of, I don't know, there's this cycle that goes on where as long as nothing is breaking, people feel empowered to spend. Of course, the problem is when things stop or the market has an event like we saw back in the fall of 2018, we've seen a couple times, consumer spending will stop on a dime because when you start seeing on the evening news, stock market down 2%, it happens over a couple of days. People say, wait a second, what's going on? Maybe I shouldn't go on that trip. Maybe I shouldn't go to that restaurant, buy that coffee, whatever. And that's when consumer spending stops. So the consumer confidence number doesn't surprise me. I guess the only sort of caveat to that is a lot of people don't feel great about the economy. But with that said, as long as the market does well, people will spend, in my opinion.
Yeah, so let's think about that, right? So you just mentioned the unemployment rate back down to 3.7%. So you would look at that and you say the economy is pretty decent, right? Inflation is coming down. I'm looking at it through the lens of the 10-year U.S. Treasury yield. We were looking at it at 4.1%. This was last week. And on that stronger than expected unemployment report, we have now a 10-year yield at 4.26, right? What if we have CPI data that's a little hot tomorrow, hotter than expected? And this goes back to that November 13th reading that we had that really sparked things, right? That was after that Nov 1 Fed meeting. What if we're going to have some sort of retracement from that, like month and a half or so, and we have a 10-year yield on its way back to 4.5%? At that point, where should stocks be? Because the last time we were at 4.5% on the 10-year, we had, the stock market much lower. It was, 4,300. Here we are, 4,600, right? Like, so I'm just thinking about it in that regard. We might have volatility over the next couple of months in some of this data. And if we have yields that were at 4% at the end of August, they went to 5%, they came back to 4%, we might find ourselves somewhere in that 4.35, 4.6 range or something like that. to me, I don't know how supportive that is for stocks at these valuations, right? You know what I mean? Like, so how are you thinking about that into year end? Let's assume that we just started out by talking about that the S&P, at least the options market is implying 2% in either direction. Let's just say it's either side of 1% from here or so. How does that set us up in the new year with a rate environment that we might see the rate cuts start to get pushed out a little bit, right? They got pulled forward. If we start seeing pushed out a little bit, what does that mean for stocks?
Well, they already did get pushed out on that jobs data. You saw them not necessarily pricing in all of March. The way that I look at how rates are priced in and when cuts would happen is if the implied move is more than 12 and a half basis points, I count that as it's priced in. It sort of unpriced itself midday on Friday. So March was no longer the first cut. It got pushed back out to May. The interesting thing about the beginning of 2024 is that we skipped 2 months right away of Fed meetings. So there isn't an opportunity for them to make a move every month. So we've got this kind of protracted, even Fed cycle that's going to happen. There's a meeting in January, then we skip February, then there's a meeting in March, and we skip April. So it might end up being prolonged just because of the way the calendar works. But what I think would have to happen is what drove this rally in the first place? What drove it was that 10-year yields came down, 2-year yields came down, inflation was coming down, and then you saw all those growth stocks really start, and then you saw the broadening out because people were worried about missing the rest of a rally, but they didn't want to take their money out of the equity market. So if we start to unprice rate cuts early in the year, I would imagine yields have to rise, and then part of the rally that we've seen since early November does have to be given back. That doesn't mean that we're going to have this big drawdown, but I do think that right now we're priced for rates to continue to come down, inflation to continue to cool. So if there's a tick back up, I think we have to see a reversal in some of these gains.
Yeah, and Guy, in a whole host of industries, as inventories have come down, as companies have done a better job dealing with the kind of after effects of the supply chain disruptions, first from COVID and then from the Ukraine war, it's kind of interesting. I think that's something that a lot of investors have actually felt really good about. I listened this morning to a podcast with Mark Esper. He's the former defense secretary in the last administration, and it was interesting. Kind of his take on what's gone on with Russia and Ukraine, what's gone on in the Middle East, what's could potentially go on with China and Taiwan. And the message that was very consistent throughout all of them is that the Taiwanese should be stockpiling right now because I'm sure the Ukrainians wish they did, right? He's also a hawk on Iran. Okay. And so when he thinks about that, so he is in support of Ukraine, he is in support of Israel, right? And he's in support of the Taiwanese, okay, being a much stronger front for if merely for a deterrent standpoint. And if you were to think about how inflation got really out of whack in 2022, after we all felt like COVID was pretty much in the rearview mirror, right? If we were to have some of these geopolitical situations start to get dialed up, and one of them obviously could be China and Taiwan. And you've made the point, I think we talked about it on last week's pod a little bit, or we've been talking about it for months now. The Chinese economy is weak. There's deflationary readings all over the place, right? And we know how much the global economy has relied on them in general. Who knows what sort of actions they might take in the new year? Who knows what sort of fronts could open up as far as in the Middle East and this, war with Hamas between Israel. And at some point, we are going to see, either an all-out, aggressive push by the Ukrainians to get as much aid as possible in anticipation of a spring offensive. Okay, and we know that I think Biden invited Zelensky this week in front of an aid vote, or you know what I mean? Like, so at some point, my question, in a long way of saying this, Guy, is like, might we see a massive inventory restocking on a whole host of different, items? You know what I mean? That could be inflationary for the globe for a number of different geopolitical hotspots.
I think that's fair. That's an interesting podcast. If you listen to Esper, he's a brilliant man. I'll say this, the Chinese historically stockpile, but they've been doing it in sort of levels we haven't seen for the last couple of years. So, they're ahead of this curve in terms of, what you're talking about. And quite frankly, you have to ask yourself, what are they stockpiling for? And I think I've thought for a while. Now, this has been incorrect as well, and I'm surprised that I'm not that I'm wishing for it to happen, but I think there's this inevitability to China and Taiwan in some form. And if you just listen to the rhetoric out of President Xi, I mean, he seems pretty dug in in terms of his feelings about Taiwan and what it means to China. So, what does it mean for the global inflation? Well, let's put it this way: it's not deflationary, right? It's not a good thing necessarily for inflation. And again, I don't think, if I look at it through the lens just of the stock market, there's no preparation for this whatsoever. And I think there's this sense, as long as there's no news, why try to get ahead of something that may happen when you can be in front of something and sort of ride this wave? And I think that's what people are doing. Now, of course, there's the thought behind that is they'll be able to get out in time. We'll see if that's sort of, if that's the case this time.
Yeah, and Liz, what are your thoughts? There was, 1 year out inflation expectations. They seem to be dropping like a lug a little bit here. And how important is that versus a headline CPI, you know what I mean, that we're going to get versus expectations? And, we talked a lot about, we just got through Q3 earnings season, and visibility is a term we use a lot, right? A lot of these companies, when they're not willing to give guidance much further than a quarter or give guidance at all, a lack of visibility should be something that weighs on a stock, or at least from a valuation standpoint, right? And we talk about all the time this idea in front of an earnings event, the implied move. Well, the more visibility, the more color a company has given, right? You know what I mean? The less expected volatility there should be. And I think we are living in an environment, at least on the corporate level, where a lot of them do not have a whole host of visibility, right? But, if you think about the geopolitical backdrop that we just described, it also is one of those things that seems to be, in flux here. And so I'm just curious, like again, with the VIX at 13 and the 10-year where it is and all this sort of stuff, like what's being priced in right now, you know what I mean, for the lack of visibility that we have headed into 2024.
Well, I think the lack of visibility and the rally that's happened just speaks to risk appetite of investors, because you pull that visibility closer, and you've got companies coming out third quarter earnings not giving full year guidance or pulling full year guidance and only comfortable talking about the next quarter or maybe the first quarter of 2024. So I think there's probably a bit of recency bias going on where, okay, things were better than expected in 2023. That's probably going to persist into 2024. That may or may not be the case, but if investors don't have anything else to go on, that's what they're going to buy on. And there's obviously appetite for risk taking. The thing about inflation expectations, you have to think about it this way. The Fed is really, really obsessed with inflation expectations. They talk about keeping inflation controlled, not letting it get entrenched. What does entrenched mean? To them, it means inflation expectations are under control. So if inflation expectations are coming down, that's going to satisfy the Fed over time, and that's going to send them the signal that they've got things under control. Your question about headline CPI, the headline is what people are going to answer something like the University of Michigan survey on, right? You see a headline that inflation is coming down, you get asked questions about how you feel about inflation, you say you feel great about it. The reality, and this is going to be in my outlook, the reality is if you look at the cumulative effect of those non-negotiable categories, so things like food, shelter, transportation, and energy, the cumulative effect since 2019 is that all four of those categories are up over 20%. If you look at the cumulative effect of wage growth, now, if prices are up over 20% in non-negotiable categories and wages are up over 20%, that's probably okay because you're absorbing it. Wage growth was up, but it's up under 20%. So there is a gap between what people have made as an increase versus what they've had to pay as increased prices. And as we've talked about over and over and over again, inflation has just slowed down. It has not reversed. So the headline CPI number makes people feel good. The reality of what's happening in their bank account, not so great. The Fed is going to be satisfied with inflation expectations. So there's this pretty big mismatch about what's really going on the ground, what the Fed is going to use to run policy, and what people are thinking and feeling is actually going on.
Guy, Liz just used that term investor appetite for risk. And there's two headlines, and I think you're going to have opinions on both of these. Occidental, okay, is buying a private shale driller, okay, for what, $12 billion. This is a private company. Really interesting, right? And then another one was Macy's. An investor group is looking to pay $5.8 billion. This is a company that has over $6 billion in debt, just to be very clear, for that company. So they're going to pay over $20 a share for it. And it was just trading at about $10.50 a month and a half ago. Okay, so when you do the math, right, like on something like that, and you look at an Oxy, and we've talked about this name a lot. We've talked about the M&A in the space. It looks like there is investor appetite for deals right now. And so, just give me your take on that. Seeing those two headlines over the weekend.
Here's what I'll say about that, Dan. You're not suggesting there's any similarities here. There are only similarities in there's deal making taking place, which historically has been a good thing. The Macy's deal to me reeks of a group that's going to come in and probably gut the entire thing, maybe become some sort of real estate play with some sort of restructuring of debt. We'll see. I tweeted it last night. This is eerily reminiscent of Gordon Gekko's play for Blue Star, where he comes in pretending he wants to save the airline only to sort of break it up. So we'll see how that plays out, number one. Number two, in terms of Oxy in the energy space, it's fascinating now. This is the third company in that space that have made or at least signaled acquisitions over the last month and a half or 2 months. Whether or not they come to fruition or not, I don't even know if that's the point. It's the confidence that they have which to do so. So, in one regard, I think it's a great sign that there's this unfreezing of deal making. The flip side of that coin is I think they're extraordinarily specific to both the companies and the industries.
Yeah, and I guess the connection that I'm making here is the investor appetite for risk. If you think about, an investor group, the sort of, I mean, listen, they're looking at the debt here, right? And they're looking at interest rates here, and they're looking at real estate, and they're looking at a lot of these dynamics that you talked about, that are going on in the department store and all that sort of stuff. So like they must have a plan here. And then I think about, the Oxy deal, this is a public traded company, probably making the largest acquisition it's ever made or attempting to do that. They have to have buy-in from their largest shareholders. One of those is, the Buffett group, right? The Berkshire Hathaway and stuff like that. So it all speaks, if you want to just kind of thread the needle a little bit, of investors in general, whether they be to publicly traded companies or like looking to take something private and then, kind of deal with all the kind of machinations that come with that. There seems to be an appetite for risk. And Liz, this was a headline that kind of caught my eye last week. Ken Moelis sees huge backlog of deals after Fed's rate hike regime. And it's interesting, Guy. I don't know if you were on the show a few weeks ago, but Julie Beal, one of our co-panelists, she pitched Moelis as a company. She's a small cap investor and she looks at value. And she said that here's a company that's cut costs. Actually, she said, here's a company that has not cut costs, versus some of its peers in the space. And they are getting ready for, this period of aggressive M&A and the like. And that's something that we could see in 2024. And Guy and I remark about this all the time. We sit there and put our M&A banker hats on when things look really nasty and no one wants to buy anything in the public markets. Deals never get done at those sorts of levels, right? For any reason, they get done really as people are starting to feel maybe overly confident about whatever sort of period they're about to enter into.
Yeah, well, there's two different types of M&A. There's strategic M&A and there's financial M&A. If we're seeing deals happen and the general gist is that companies are being overpaid for, then I think the risk appetite issue is pervasive, right? You've got companies that are maybe overvalued, getting taken over at a really high price. That's something that would be a warning sign. I don't know enough about the specific companies and some of the deals that have happened recently. That airline one is the one that comes to mind most recently that I think people really thought they were overpaid for. Every industry is going to be different, but if you start to hear about M&A from a standpoint of more financial reasons, and that could happen in certain sectors and not others, that's when you start to worry about, okay, now companies are being saved, right? They're needing to be rescued. That probably doesn't happen though until we're in the depths of something bad. And we haven't seen that yet. We really have not seen a ton of those types of deals. So the idea right now is the deals are going to happen for strategic reasons, and this is a healthy indicator, and the IPO market might be back and the M&A market is back. Like there's a lot of talk about that. There's a lot of chatter about that. One of the things, and this is going to get Guy all turned up, but one of the things that I tweeted last week, I don't remember if it was Thursday or Friday, it was a headline from November 29th, 2006, basically saying Fed sees a soft landing coming. It wasn't even just the headline. I read the whole article. You could literally replace Bernanke with Powell. You could just change the dates and republish that article and nobody would know the difference. It's exactly the same stuff that we're looking at right now. There was some statement in there. Fed is confident that they can keep bringing inflation down without tipping the economy into recession. Now, I am not by any means suggesting that we are heading for something like what happened in 2007 and 2008. But the whole point of that was to say we always talk about soft landings before we know whether or not it's a soft or a hard landing. And we're in the same spot right now, talking about the same indicators, the same concerns. Everybody thinks that it could get pulled off, and it could, but this time is probably not as unique as people want to believe that it is.
So you're saying this time is not different. One other thing on the on the M&A front is I think you're going to see a bunch of these SPACs from 2020, 2021 that are trading like at $1 or $2 or something like that. You're going to see some strategic M&A. You're going to see private equity kind of take some of these things out. And so that'll be something I think that happens in 2024 because some of these things just don't look particularly manageable because of the actual structure that they have. You know what I mean? And I think they're probably weighing on, like when you think about what are the things that get, employees jazzed up about working at companies that went public, about a stock that's going higher. If you think that your stock is never going to go higher and you're just mired in this kind of like you came at a $2, $3, $4 billion valuation and you're all geeked up about it. And 2 years later, the thing's trading at a couple $100 million and it's left for dead and no one's talking about it anymore. You're going to lose some of your best talent. So I think that there's going to be some roll ups, some strategic M&A and some things taken private. All right, let's hit some earnings here. We're not done with this earnings season. Tonight after the close, Oracle is going to report, Guy, 6% implied move in the options market. This stock was trading very near an all-time high 3 months ago when they reported, disappointed, gave kind of weak and a weak outlook. The stock gap down 13%. That's a kind of big move. The stock is, a $300 billion market cap company, a lot of recurring revenue. We know that it seems like every cycle they are pushing to kind of demonstrate how they are there, whether it was this move into SaaS, whether it's this move into AI, data centers, like public cloud, all that sort of stuff. Stock has rallied almost 15%, Guy, in the last month and a half or so. Expectations high. We've seen, some kind of diverging results from some of these kind of, second tier players as it relates to cloud and AI. Expectations there. And then later on in the week, we have Adobe that also has an implied move about 6%. Are these two names important to you? Both about $300 billion market cap companies.
Yeah, I think, listen, Adobe, they're both important for different reasons. I mean, Oracle, I guess, in terms of valuation, maybe it's a little more reasonable than some of these other companies in the same space. If you want to compare it to like a Salesforce, I'll say this. Obviously, that last quarter was interesting in so much as I think it was September, early September. Stock, to your point, Dan, was making, believe it or not, an all-time high for Oracle, which is remarkable when you put it into context of where this was back in the heyday. And then it fell off a cliff. I think it went from sort of 126, 127. I think it printed $100, but we've gotten about half of it back. Valuation, not unreasonable in this environment. We're going to push towards that level again. Do we fail for the third time or do we push through? I think at this point you're flipping a coin, but I think it's going to be interesting to hear the commentary because obviously last quarter wasn't great. Adobe to me is fascinating because valuation is clearly expensive. It always is. I think 35 times next year. A stock that I want to say made an all-time high in November of 21, sold off, has gotten the lion's share of it back. We're probably within, I don't know, Dan, 12% of another all-time high. So keep your eye on this one because the potential to make a massive double top, I think, exists.
So Liz, Guy and I are struggling with this on the single stock front, right? So, normally as one of the like main inputs that we would use to kind of differentiate a stock versus its peers, versus its history, versus the broad market would be valuation, right? And in periods like that, no one cares, right? So Guy just said that Adobe is trading at about, 34 times next year, right? So this is a company that's expected to have 13% earnings growth, 13% sales growth, 89% gross margin, okay? Trading at 34 times in an interest rate environment like this. But most importantly, let's say on the cusp of like harnessing one of the most important technologies, right? Like, like the world has ever seen. And I say that kind of in jest because this is a company that invests and has been investing billions of dollars in machine learning in and around their products and services for years, right? So like AI to a company like this, yes, there are new technologies right now that are like kind of, getting investors excited, getting, product people excited and all the like, but there is not right now any evidence of like this amazing commercialization, which makes a company like this that has had 88 or 89% gross margins for years, growing double digits, that it's going to accelerate revenue growth or profit growth in a way that should justify a higher multiple. But you could say on a PE to growth or whatever other growth metrics, it's expensive, right? To itself, to its peers, and to the market. But people don't care. And that's one of the reasons why Guy and I are trying to be a little bit careful of like putting too much emphasis on valuation. Thoughts on that?
Well, valuation, as I think all of us know, and probably most people listening know, is a really bad timing mechanism in the sense of telling you whether or not you buy the stock today or sell the stock today. What it is good at, though, and this is absolutely consistent through time, if you look at something like the Case Shiller PE and you chart that over time, what it's good at is telling you what the, let's say, 10-year return expectations are going to be. If the argument for, if you're making a bull case and the argument is, well, over the long term, just draw a chart of the S&P, it goes up and to the right. That is true, which means that you're probably more focused on a 10 to 15 year time horizon. If that's the case, overpaying for a stock today does not suggest great things about that return potential. And if nothing else, if you're overpaying today over a 10 to 15 year period, you might actually underperform the broader market if you pay too much for it in the moment. So something to think about. The other piece of it is, just like Christmas transcends everything, right now AI and tech is transcending everything. There is so much exuberance over how this is going to change the game for everybody. People are still trying to pick the winners, and the momentum is just moving in that direction. I think that this is a theme that obviously is going to change things. Are we going to get justification of those multiples by March? I don't think so. But it's something that I think you just have to let the clock run on. You have to let it sort of run itself out. You have to let people get into stuff until it's overextended and then it comes back down to earth. That is how most of these things go. Any new theme, any new stock, any new industry, you have that boom and bust cycle before it settles into where it rightfully belongs.
Yeah. All right. Last one before we get out of here. And this is actually tying a couple of those themes that we just talked about with those software and the valuations and expectations and relative value to peers. Guy, Costco reports, I think Thursday after the close, implied move about 2.7% in either direction. It's generally not a big mover. It moves about, 2% or so at a new all-time high. And you and I were talking about the chart, and we'll probably throw it in the show notes here. This could be the mother of all double tops. Huge move here. And, this stock trades at about 40 times 2024. Okay, that's fiscal 2024. Earnings estimates expected to grow, let's say 9% on about 6 or 7% sales growth. Okay, just do the math versus Walmart, which is also expected to have 9% earnings growth in calendar 2024. Okay, that slower revenue growth expectations, but we know that like 3 or 4% of Costco's revenue is recurring, right? And it's a very high margin sort of business, and that membership sort of fee. How do you think about a name like this that trades nearly double the PE of something that we would think is their largest competitor for all intents and purposes in Walmart and the like here? Because that doesn't make a whole heck of a lot of sense.
It's interesting. It doesn't make sense to me. I think they get rewarded because I think they have a 94% rate of return in terms of that subscription or whatever term they use for their customers, which gives them visibility, which allows the market to attach a higher multiple. But at a certain point, even with that visibility, the multiples get a little extreme, and I think that's where we are now. Again, we've talked about it's a great company. I mean, we're not sort of knocking Costco or any of these companies. All I'm knocking now is the valuations and the expectations around those valuations. So in order for them to think about it, in order to maintain this level, they have to do extraordinary things. And I think we're getting stretched here as well. So, and we've seen it with a number of different retailers. I get the have and the have-nots, and Costco is one of the haves. Of course, the market is rewarding them handsomely to be so.
Yeah, well, new all-time highs there, pal. All right, people, we covered a lot of ground this week. You know, when you think about it, CPI, you think about that Fed meeting, we have a couple of big earnings. We covered all that. Once we get by that with no big hiccups, to your point, Liz, the idea that you probably have a little bit of a melt up into year end makes some sense. I'll just say this, that this is not me kind of throwing in the towel on what was a bearish call, because a month and a half ago, it looked like the S&P was on its way to being unchanged on the year, when we had, the Russell down on the year, we had the equal weight S&P 500 down on the year, that sort of thing. And so, if the everything rally, there it is, guy, right before we get out of there, is just predicated on a move in the 10-year going from 5 to 4.25% in a month and a half, when the yield wasn't even like for that long above 4.25%. You know what I mean? Like, that doesn't make a lot of sense. So I kind of feel like the higher we melt up into year end is the harder we drop in Q1. And I think that a lot of things that I'm seeing remind me a lot about late 2021. And we kind of know what happened in 2022. So we will see. So thanks for being here early on a Monday morning, people. Stick around. Guy and I had a great conversation with Jeff Toporek. He is the principal at FD Stonewater.